The topic for today's podcast is investment banking. We think if you act like an investment banker in your own life, you'll be more profitable and get ahead faster financially.
The way you think and what you think about is the foundation for what you do. We think that if you act like an investment banker in your own life, you will have opportunities to create wealth like bankers and businesses.
When it comes to finances, it's beneficial to think like a banker. Fact is, I often tell people to put your banker's cap on, and I'm literally going to do that right now because today we're going to talk about banking and the infinite banking concept right here on Wealth Talks.
Investment banking and banking, they used to be more synonymous. Back before the 1930s, they were the same sort of position. You picture the stereotypical banker, the fat cat sitting in their gilded room. Those were a combination of the investment bankers and the banking industry that we think about today. But in the 1930s, the Glass-Steagall Act separated the two industries. So then you had investment bankers in one bucket and you had retail bankers in another bucket. And a lot of people that work in the retail banking sector today don't understand the full picture of what banking is about because they don't see the investment banking side. The investment bankers are the deal cutters. They help with the mergers and acquisitions, the IPOs, and some of the deal making that happens in banking behind the scenes. And the reason the Glass-Steagall Act, the reason they wanted to separate these two is because they saw that banks had been using their customers' money to invest on the investment side of things, and they thought that that had contributed to the crash in 1929.
The Glass-Steagall Act separated investment banking from what we see as banks today. Banks today still have to go through the process of saving a lot of money, like $20, $30, $40 million, before they can go to the comptroller of the currency to get their charter. And then they have to still get insurance from the FDIC or from some state-run insurance company if they're going to be a state bank. So they still have to go through a process before they can even take our money on deposit and lend it out to others. Banks never lend their own money, whether they're an investment banker or whether they're a bank like we see on the corner. They're always lending depositors money. And the Glass-Steagall Act just separated the risk of our deposits at the local bank being just thrown away in an investment that was maybe going to fail.
They used to be separate like that up until 1999. And then another act was passed, the Gramm-Leach-Bliley Act in 1999. And now banks can still do some of that behind the scenes, but they still have their separate departments that tend to handle. The investment banking department tends to handle those bigger deals for corporations, the mergers and acquisitions, the IPOs, things like that, whereas retail banking is more focused on the everyday customer.
So when we're talking about investment banking, we're not just bringing all these terms to confuse and muddle the pot. We're actually saying, what does it take to be an investment banker? What are the qualities? And how can we use these qualities in our own life to manage our money better?
Skills that an investment banker should have. They need to be able to think objectively. They need to be able to understand complex situations. They need to be able to be competitive. Investment bankers are often competing with investment bankers from other banks that want to be in on these big deals. And then you have to be able to put a deal together. You have to have the contacts that are going to be able to raise the necessary funding and to be able to bring everything together. So as an example, something an investment banker will often do is if a company is going public, then they'll buy the initial shares of that offering, the bank will, and they'll put up the financing for it. Maybe they'll put in some other partners on the deal. Then they hope to make a profit when they sell that stock. And if they undervalued something about that IPO, then they might end up having to sell the stock at a loss. But if they did their groundwork correctly, then they can make a big profit on it. So that's one of the things that an investment banking firm might do. On the flip side of that, you have retail bankers, and the manager at your local bank isn't necessarily going to understand how the banking function works because all they see is they see people coming in to get credit cards, They see people putting money into savings accounts. That's what they deal with on a regular basis. They don't necessarily understand the behind the scenes strategy that's going into the banking business.
Well, we absolutely know that is true because years ago, your dad went in to talk to a potential client. He did become a client, but he worked at a bank. And as he was explaining the banking process to him, he said, "Oh, so that's how my bank makes money."
Exactly.
And here he was, the branch manager.
When we're talking about the differences is between the branch manager of your local bank, they see the front end of that business. The investment banker, and why we're differentiating that term as we talk today, they're seeing the behind the scenes strategy.
And to do that, you have to think objectively instead of subjectively. So I think of my friend Nadine, who worked at a bank and also a credit union. My time in knowing her, she went bankrupt twice. But she worked with customer service, helping people balance their checkbook. And she was very, very good at that because she could step out of that situation and look at it objectively because it wasn't her money. She wasn't very good at subjectively managing her own money because she couldn't objectively look at it. And so to become your own banker, you have to be able to step out of your subjective mindset and look at your finances objectively like a banker.
That's why you put on that banker hat.
You got to think like a banker, so put on your thinking hat.
When you're trying to think objectively about your own finances, think about yourself as putting on that other hat. And maybe that'll help you to think objectively.
You know, I see this frequently when people say, well, I can earn a higher rate of return than what the insurance policy has given me. And that's not the point. That's not objectively thinking. That's very subjective because they are missing the time factor here. So we can borrow money and pay a higher interest rate on it and save money for a period of time at a lower interest rate than what we're paying on the borrowed money and come out ahead. Banks understand that. Bankers and investment bankers particularly understand that. And to put some hard numbers in that is you can borrow $50,000 from a bank, pay them 6.75% interest over 10 years, which is about $574 a month. If you have $50,000 sitting in a savings account earning 3.5%, over 10 years, you're going to make more money in your savings account than what you paid in interest to the banker for their $50,000 loan.
Because if you take the $574 payment that you were making to the bank at that 6.75% interest, you're going to end up paying over $18,000 of interest, almost $19,000 of interest. But your savings account that was growing at 3.5% for the same 10 years, that will grow to be over $20,000, closer to $21,000 of interest over that time. So that's your profit there. That's the differential of the time because your savings account is compounding and growing over that time, whereas the loan is compounding on a decreasing balance as you make payments.
And a banker understands that because their money is earning a very low interest rate. Remember, they don't loan their money. And so they can make that split work in their favor when they lend the depositors' money out.
You say the bank has their own money sitting aside at a very low interest rate. Why is that? How did they have to get started and keep their money at that low interest rate to become a bank?
They had to raise $20 to $40 million before the comptroller of the currency would even give them a charter to do business. And the charter says you cannot loan your own money. If they loan their own money, they lose their charter. Banks always use someone else's money to lend. So once they get their charter, once they get their insurance from the FDIC or the state insurance company, now they have to attract depositors. And so I remember Nelson Nash said this is when they give out toasters and things like that to entice people to come in to put their money with them. Now they might give a little higher percentage rate, like maybe, 2 basis points or something like that, to entice people for a short period of time to get their money with them. But the key is that banks don't lend their own money. They always lend somebody else's money because their money has to be kept as a reserve for their charter.
As they lend their depositors money out, people put money in savings accounts and checking accounts, and then the bank is going to lend that money out on credit cards and car loans and things like that. So they're making money off the spread between the difference of those two.
Just like we were making the difference off the spread here, where if we save our $50,000 and come up with $70,000 in 10 years in that savings account and only had to pay, like $68,000 to the bank for their $50,000 loan, we just made $2,000.
I've heard people say, that you can borrow money at a higher rate, save money at a lower rate, and make money. It's the time differential that's involved there. I've also heard people come at this and say, well, that's not really a full example because, if you took the payments on the loan at 6.75% and you made the payments back to the bank on that, and you took those out of your savings account, then you're not going to come out ahead. So the reason you're coming out ahead is because you're taking out of your own pocket to make those payments. And that's absolutely true. But that's what people are doing all the time. They put their money in a 401k. They put their money in a savings account. They're earning in a savings account, well, maybe hardly anything, maybe a little bit more if it's in a high yield savings account. In the 401k, maybe they're earning 5 and 7%, but they're paying 19.99% on the credit card. They're paying 8% on a car loan. They're doing this every single day.
They're not considering the time factor. That interest they're paying is basically buying the time. And that's why we see so many people, when they get to the end of their life, they don't have enough money that's going to last them a lifetime.
Tom wrote about another example, not using 50,000, using different interest rates, but he told of another example in Prescription of Wealth of where you can borrow at a higher percent than what you're saving at and still make money. This book is available at McPheeinsurance.com. It's a free download as an ebook or an audiobook, so you can get a copy of that. When we get back from the break, we're going to talk about some particularly brilliant decisions some of our clients have made as they manage their own finances.
The policy that works best for the infinite banking concept is a dividend-paying whole life insurance policy with a paid-up additions rider. You'll want this policy to be structured to allow the maximum cash value accumulation without creating unnecessary tax consequences or inhibiting the cash value growth for future policy years. At McPhee Insurance, we specialize in these types of policies. We are licensed in all 50 states, so no matter where you're located in the U.S., we can help you. Call our office at 702-660-7000 or email us, team@mcpheeinsurance.com.
Now that we're back from the break, we're going to talk about some of our clients and their brilliant decisions for how they're managing their money. We're going to start with Erica. She's an acupuncturist in California, and she started a life insurance policy with us. And after a number of years, she had the opportunity to purchase her dream condo with an oceanfront view. And she was able to borrow the money that she had been paying into several different policies and purchase that condo. And I remember when we got to go visit her and see the sun set over the ocean. It was beautiful.
Now, Erica couldn't have done that if she hadn't have built that reserve in those policies. Remember, the bank, to get started, they have to have $20, $30, $40 million before the comptroller will even think about giving them a charter to operate as a bank. So Erica started her reserve by putting it into life insurance premiums, and now she had the capital to be able to finance that condo, that dream condo of hers.
She is basically financing on a small scale the way that a banker would have to do. She built up the capital. She piggybacked on the life insurance company to do that because a life insurance company had to get into business very similarly to the way a bank has to get into business. They had to have a large pool of capital that they set aside as a reserve. So by Erica starting her life insurance and building her capital that way, she's piggybacking on what the life insurance company has already done.
And it was kind of exciting because, she was very excited about this condo. It was her dream, but she still stopped and thought objectively about it. She looked at the numbers and it wasn't...
Put on her banker's cap.
Exactly. She put on her banker's cap. And it wasn't a decision she made immediately. It wasn't a snap decision. She spent several weeks looking at the numbers, deciding if this would really be something she could do or not. So she was thinking like an investment banker. Would this desire of hers also be a good investment? It turned out it was.
That policy loans that she took to buy that condo, she's been paying that back. And just recently, her landlord for her office said, "Oh, we're going to jack your rent sky high." And Erica goes, "Wow, at that rate, I could buy my own building." And so she looked around, she found a building, and she looked at the money in her policies that she had repaid and how it had grown. And she didn't have quite enough money to make that office down payment. But she had been sharing her banking history and story with friends, and there was a friend of hers who had been buying policies that had listened to Erica, that was willing to become the investment banker for her and lend money out of his policy so that she got her office building.
Not only did she get her dream of where she wanted to live, but now she's in a position to purchase her own office building even a few years later after that. Were those planned investments that she had in her mind before she started her policy? No, but they were opportunities that came because she was thinking objectively.
Erica had taken the time to set aside that money in her life insurance. Just think if she had set that aside in a savings account at the bank, maybe even a high yield savings account that was earning a nice interest rate. Well, when she takes that money out to go buy the office, to do whatever she's going to do, the growth on the money she had saved stops in that high yield savings account or wherever it was. If she takes the money out of the life insurance policy, she's not technically taking it out. She's taking a policy loan on what's there. The underlying policy continues growing. So if she pays that back, she has not lost the compounding curve. She just paid interest for the time that she had the loan outstanding.
And that's the banking part of the question that most people don't objectively see because they're so subjectively looking at what interest rate am I earning and what interest rate am I paying. They don't look at the time factor and see, oh, wow, this makes a difference.
Sometimes that's referred to as lost opportunity because when you took the money out of the savings account, you stop earning that return. What could you have earned if you didn't take that money out? That's called lost opportunity. Well, when you take a policy loan on a life insurance policy, you're minimizing that lost opportunity because you still have the underlying growth in the life insurance cash values over time, but you're paying interest on it during the time you have it out. So by the time you pay the interest back, yeah, you had an interest cost there, but you still have that underlying curve that helps to overcome the lost opportunity.
Michelle, I'm thinking of another client of ours, David in Michigan. And David is a mechanic that runs a used car dealership. Those of you that aren't familiar with car dealerships, they have special financiers, banks, investment bankers, that are called floor plans. And what they do is they provide a car dealership with the money to put a car on their lot. And they say, well, if this car stays here 30 days, we will charge you just a really, really low interest rate. But if the car stays there one day longer than that, the interest rates go way high. And so it incentivizes the car dealership to move those cars quickly so that they aren't forced to pay that high interest rate. Well, Dave and his wife had been buying policies for a number of years, and they had used it to buy duplexes and whatnot. They also used it to buy his shop. And now they said, wait a second. We've been saving money in our children's policies for their education. Why don't we leverage that money, borrow against those policies, and be our own floor plan? We can pay that same interest rate back to our children to increase their college education fund. And so that's exactly what they're doing. And they're not forced to make car deals happen within 30 days because they're just going to be paying themselves back that money anyway.
This reminds me of what we were talking about before, a little bit before the break, when you were talking about the $50,000 that if you had to borrow it, you'd have to pay 6.75%. But what if you're going to accumulate your own capital? It takes some time to do that. And so what if you had made the payment that you were going to make to the bank, the $574 a month? What if you had done that for 10 years? That helps you to build up to the $50,000 of capital, doesn't it?
It does. So if we go back to the rates of interest we were talking about before the break, if your savings account can only earn 3.5%, and you're putting $574 in there a month, it's going to take you 6.5 years before you have $50,000.
So that gets you to ground zero.
That gets you to
6.5 years.
So if we take that money out, like a lot of people do, and go spend it, we lose any more growth. It's gone. But if we just let that $50,000 sit there for the next period of time, earning 3.5%, it will grow and compound and continue to benefit us. Now, that is what bankers are doing with their reserve money. It's sitting there, compounding, growing for them. And yet, how do we have access to that? Because if we go access our savings, we lose the growth on it. And that's where life insurance comes in. We can put that same $574 into a life insurance policy, and over 10 years, we'll have like almost $68,000 that we can borrow from. So we can definitely go to the insurance company and we can say, hey, I want to borrow $50,000. They're going to use that $68,000 as collateral. They're saying, here, fine, take our money and use it. Your money will stay in the policy and continue to grow just as if you hadn't taken it.
I'm going to have to pay interest on that policy loan. How does that figure into this?
So we paid the loan back just as if we were paying the bank. That's 6.75%. Let's say we do that. $574 a month. We do that for the next 10 years. And now our cash value has grown by $90,090. Our death benefit has risen by over $80,000. We haven't paid any more premiums on this policy. We're just repaying a loan that we took, just as if we had taken a loan from a bank. That's like keeping the $2,000 of profit when we used the bank's money and had our money continue to grow at a lower interest rate. It's also like keeping the $70,000 plus that we lost when we spent our $50,000 instead of letting it continue to compound at 3.5%. And in addition to both of those, there's another $17,000 that's available just because the policy continued to add its compounding growth to our balance as well.
Another brilliant way people use their life insurance policies is to pay for something they're already paying for. And that is when somebody has debt, credit card debt, for example. They might have interest rates of 20% when they can borrow at a lower interest rate from the insurance company and pay off that credit card debt and then turn and pay back what they had been paying to the credit card companies. They are getting ahead. One of our clients, Linda, who worked on a plan to get out of debt, borrowing from her policy. It was a plan that she did over a number of years, but as the years went by, she got in a better financial position, and eventually she and her husband were able to make a down payment on the house for their daughter, give her a surprise down payment. And that came because she had faithfully paid down those debts that she had created.
Something that a lot of people will think when they're in a lot of debt, they might think, well, I've got to get this paid off before I can do anything else. And that is often one of their highest priorities, is to get that debt paid down. But if they will start building their capital reserves at the same time that they're paying off debt, we've done numerous scenarios that show over the long run, it's more effective to start that way than it is to pay off the debt and then start building your capital reserve. Now, there is a balance we have to be aware of. Sometimes it makes sense to pay off some debt before you start building significant capital reserves, but it almost always makes sense to start at some level.
For some people, thinking like a banker can be challenging at first. If you're one of those people, don't give up. It will become easier as you do it.
It has been said that encouragement comes from being faithful. And that's true about developing this habit too.
As you begin to think like a banker, it's going to become easier and easier and more profitable for you. So get out your banker's hat, put it on, and start thinking like a banker. And then come back next week when we're going to talk about some of the most popular financial advice we've heard over the last few decades right here on Wealth Talks.